Alrighty, guys, we will get going 1 minute. There is 2 people that are coming that paid from Twitter. Some of you guys are in the group and got in for free, and some of you guys paid. Give it 1 more moment and we will start. Can you guys hear me all right? Hey, Josh, can you let me know if you can hear me all right? Okay, awesome. Alrighty, guys. My name is Nick Core, as you guys know. This is the class on Ichimoku. We'll jump right into this. So what is the Ichimoku and how does it work? The Ichimoku cloud, also known as the Ichimoku, forgive me on the Japanese pronunciation of all this too. I do not speak Japanese, but it is also known as the Ichimoku Kinko Hyo, which translates into a one-look equilibrium chart. The Ichimoku is viewed as price equilibrium, and the entire theory behind it is based on that. But in theory, with one look, chartists can identify the trend and look for potential signals within that trend. The indicator was developed by Goichi Hosada, I believe is the correct way to pronounce it, in the late 1930s, believe it or not. And in 1969, after spending 30 years perfecting the technique, he published it in a book. Even though it seems complicated, it's a pretty straightforward indicator, and it's very usable. It's just understanding the mechanics of it to understand how to trade off of it. Just like any indicator, it's got its faults, and we'll point out its faults as I go through all this. But the Ichimoku cloud is a group of 5 separate indicators collectively used as primarily as a trend following indicator. The various indicator movements are similar on their signals as the MACD as far as signal generation. So if you're familiar with the MACD, this is not a hard concept to grasp. The Ichi is limited, as you'll discover and as we'll get into, due to its lagging components and also some of the noise that's not filtered out, which is why I use the settings I do use. And we'll get into that in just a moment. So the Ichimoku is a moving average-based trend identification system. And because it contains more data points than your standard candlestick charts, it provides a clear picture of potential price action. If you're a price action trader, it is a great indicator to use on top of that. However, most price action traders do not use any lagging indicators other than moving averages, which is what this is based off of. The main difference between how moving averages are plotted on the Ichimoku as opposed to other methods is that the Ichimoku's lines are constructed using the 50% points of the highs and lows as opposed to the candle's closing price that you see with traditional moving averages. So I'll add a, and by the way, if something goes wrong with the screen or the audio, those of you that have my cell number, please text me. There's a few people in here. Other than that, I have all other chat windows closed down for right now. So real quick, let's put a moving average on here so that way you guys can see as an example. We're going to put it at 20, which is the first input, and I'll get into my inputs here in a second. But we're going to make it the same color as the 20 input. As you can see, it's fairly close. The moving average is actually, let's make this a slightly different shade. We'll make it green. You can see the moving average here set at 20 is pretty close to the conversion line, which is there in orange. Again, the way the Ichimoku pulls and plots its course is the 50% points of the candle close, not so much the I'm sorry, not so much as the closing price. The Ichimoku factors in time as an additional element along with price action, similar to William Gann's trading ideas, if any of you are familiar with him. Ichimoku chart was originally formulated based on the traditional 6-day Japanese trading week. So the settings you see that come standard on TradingView and most other platforms are actually 9, 26, 120, and 30. Or I'm sorry, 920. Wow, confusing. 926, 52, and 26. Those are your typical standard default Ichimoku settings. Again, those were based on the 6-day trading week that Japan had. And they can still be used in cryptocurrencies, but cryptocurrencies are extremely volatile. And the settings I use now are 20, 60 on the baseline, and 20 on our lagging span, and 30 on our displacement. And I'll get into each one of those, what each one of those mean in a moment. But for the sake of this presentation, we'll be doing it on my settings that I use normally. The reason why I use these settings is because crypto is a volatile asset, and with these higher settings, it'll kind of weed out the noise that you get from the volatility. Again, the default settings do work, and you can come to the same conclusion with that setting and other settings, but these settings I like particularly because they, again, squeeze out all the noise that we see that comes with volatility. These settings do work on other assets also, 2061, 2030. A lot of people view these as crypto settings, but truthfully, there's a few currency pairs and Forex that I know traders use these settings on. So they're not just crypto in particular. They are just used on volatile assets. So you can play around with the settings however you'd like and find something that fits for you. There may be better settings for this in crypto. I haven't really explored these settings beyond this. These ones I like, and they filter out the noise enough without filtering out too much of the movements, because you still want to have signals that comes from the Ichimoku and its components. The higher you go, the less signals you get. So it's kind of a balance in between. Again, this indicator is an equilibrium indicator, and so you want to kind of have an equilibrium on the settings also. Changing the settings can be done based on the asset or time frame. I typically stick to the asset and don't adjust them on the time frame when I'm using Ichimoku on in traditional trading, such as some less volatile Forex currencies. I do place them on default, but as a majority of the time of the things I do trade on nowadays require this, which is almost entirely crypto. I really don't do any traditional trading anymore. My settings are considered high, so if you are using a more steady, or if you are using Ichimoku on a more steady asset, maybe you do want to go back down to default or something that's around half of these, such as 10, 30, 60, 15. Well, I'd leave displacement at around 30. But it does allow you to filter out the noise that we get from the extreme volatility. So let's get into the components of each of these. Hold on real quick. Let me check the chat, see if there's any questions. I'll get this clear. This is legit. Say, Alex, this is legit. Are you really live, or are you a bot? See, I am not a bot, guys. Or maybe I just paused the bot to read your questions. We'll see. Anyway, I'll check your guys' questions periodically. Feel free to place them in there. If I forget, I'll get them at the end, but I should remember to check most of these. Okay, so there's several components of the Ichimoku that you need to understand to really be able to master the Ichimoku. There's the Tenkan-sen, which is the conversion line, the Kijun-sen, which is the baseline, the Seiko span A, which is a faster moving span, or leading span 1, as it's called here on TradingView. And then there's Seiko span B, which is slower, or leading span 2, as it's called here on TradingView. The Kumo, and also the Chico span, which I'm not sure if I'm pronouncing Chico right, but I've never actually heard that word said out loud. A lot of traders do not use the lagging span, which is the English version of that. I do not use it. I disable it. I have it on now. We'll go through that in a little bit, but I generally find the lagging span useless, and it just kind of clutters up my chart because I already use a number of indicators as is. All right, so let's get into the conversion line, or the Japanese wording of it is the Tenkan-sen. So this is the fastest moving piece of the Ichimoku. We're going to hide the price action actually for this. This is the fastest moving piece of the Ichimoku, and it's right here in orange. Another thing in my settings is, seeing as I use a number of indicators, I have changed my conversion line to orange, my baseline to pink, so that way I can view these visibly. I also turned up the leads for this presentation. As you can see, they're kind of bright. I turn those back down, but I do have the baseline and conversion line typically up pretty high in orange and pink on my charts if you ever do see them. I do that because if I do have any moving averages or any guppy, multiple moving averages on there, they can get lost in that. And I like to have clarity when I'm viewing indicators, even though most of these components of the Ichimoku will match moving averages. I still do like to see the separation of them. So the Tenkan-sen is the fastest moving piece of the Ichimoku. It's primarily used as a signal line, and it can also be used as a minor support or resistance line depending on where price action sits in relation to it. It's the midpoint of the 20-day high-low range. Now, if you're on the standard settings, it's the midpoint of the 9-day or 9-period high-low range. For this, we are on my settings, which is 20. So the 20-day, since we're on the daily chart, this is the average of it at the 50% range. The Tenkan-sen is an indicator of market trend. So if the Tenkan is moving up or down, it indicates the market is trending. If it moves horizontally, it means it signals that the market is ranging. And what I mean by that, most price action traders, first thing they do when they look at a chart is they want to see if the market is ranging, which is what we have been doing for quite a while now with Bitcoin. This is considered ranging right here. This is not trending. We had a slight trend right here, but generally we've been ranging for quite a while now, around a month really. And this is not the best scenario for a day trader or a price action trader or any technical analyst. But the one purpose that the conversion line, which is the English version of the Tenkan-sen, by the way, I will be going back and forth between saying the English version of it and the Japanese version of it. I don't mean to do that, but it's just out of habit. It's not out of habit of sticking to one. So bear with me on this, but the conversion line is the Tenkan-sen when I'm referring to that. So it can also, as I was saying, it can be used as a trending or a ranging market indicator. As we can see here, it was going up, indicating that we were beginning to range. Let's put it on something more volatile, such as the hourly, and we can see that this is leading, always moving faster than the rest of the Ichimoku components. We're going to turn those off for now. As you can see, it generally follows price action because, again, this is like, in a sense, a 20-day moving average of price action at the 50% range. But if you're not good at identifying trending and ranging markets, which is a key component to trading, understanding where the price is going and what kind of movement it's making, then take a look at the conversion line or the Tenkan of the Ichimoku. It's a helpful indicator. Again, most people can look at the candles and see that, okay, yes, we're trending here or we're ranging here, but the Tenkan-sen will also offer you a bit of insight on whether we are trending or ranging. We'll get into a little bit more on the Tenkan-sen in a minute, but for now, I'm just taking you through each one of the components. The next component is the Kijun-sen, which is the baseline here in pink. Mine is set on 60, as can be seen there. But this line is the midpoint of the 60-period high-low range, 26 if you're on traditional. This can be used as a confirmation line, also a major support and resistance line. I really like the Kijun as a support and resistance, a major support and resistance. When we do break it, it's typically a gigantic move, as can be seen here, even though we've broken above it and then broke below it. It can also be used as a trailing stop line. It is a very useful when we are in a bull market, or even a bear market, I guess you could say, in this scenario right here. You could use this as a stop line or also as a trailing stop line. The Kijun-sen acts as an indicator of future price movement. So in theory, if the price moves higher than the Kijun, it could continue to climb higher, just like with moving averages. If the price is below the Kijun, it could keep dropping. So in a scenario like this, this is very bearish. We see price action below not only the Kijun, but the Tenkan and also the Kumo, which we'll get into here in 1 second. The next one, the next component I want to get into is the Senko span right here in green, which is also called span A or leading span 1. It's the faster moving span of the Ichimoku, and basically it is the midpoint between the conversion line and the baseline. So 20 and 60 or 9 on 26 if you're on default settings. So it averages it out between the baseline and the conversion line and plots it on there like so. It is also referred to as the leading because it's plotted 30 periods or 26 on default settings in the future and forms the faster cloud boundary, as can be seen up here. If the price is above the Senko span, the top line serves as the first support level, while the bottom line serves as the second support level. In this case, it is below the Senko span, price action is, so it acts as resistance, the first resistance level, while the second acts as a second resistant level. This leads me to Senko span B, as can be seen here in red. The red line right here forming the top of this daily cloud. This is the midpoint of the 120 period high-low range, or 52 if you're on traditional. Again, it forms the other line of the other edge of the Kumo. This area right here, for those not familiar, let me turn off price. This is called the Kumo, the cloud. So this big area of green or red, and this is called the cloud twist, and we'll get into all that in a moment. But those are your basic components of the Kumo, is your Senko span A and your right here, and your Senko span B, which is slower moving. So again, it's all in a sense moving averages, everything you're seeing with the Ichimoku. It's very similar to that, but try to look at it again as it's intended as an equilibrium. It plots the equilibrium of the market. However, when we are in an extreme bullish asset as Bitcoin is, yes, it's in a correction right now, but overall, this is an extremely bullish asset from its beginning. The Ichimoku, it does have its issues and its deficiencies when it comes to accurately trading off that, and we'll discover some of those as we go through each one of those. So back to the Kumo. So let me turn these off. So here's your Kumo, no price action, no conversion line, nothing on there. The Kumo's the space between Senko span A right here and Senko span B. When it's in a bearish trend, Senko span A is there in green, Senko span B. That's your Kumo in between. The cloud edges identify current and potential future and support and resistance levels, as I mentioned before. The Kumo cloud changes in shape and height based on price changes. Again, it's similar to moving averages. The height represents volatility, as larger price movements form thicker clouds, which creates stronger support and resistance. As thinner clouds offer only weak support and resistance, prices can and tend to break through such thin clouds. Now, as volatile as Bitcoin, as crypto is, we do get some very, very large clouds that don't always match the true price action. And what I mean by that is we will have a black swan event, such as China banning or unbanning Bitcoin for the 50th time, and we'll have serious falls or rallies in price action. I can't particularly point out a black swan event on here, but we get big dips such as there that create really thick clouds that don't necessarily reflect the actual supply and demand of an asset, or Bitcoin in this case. So black swan events can create a thicker cloud just based on like oversold conditions that it recovers from. Trying to find an oversold condition that was based on a black swan event. It's a good, trying to find a good example to show where the Kumo may be thicker than it should be. But for now, I think you get the point on that. The Kumo cloud changes in shape and height based on price changes. Got into that. The height represents volatility as larger price movements form thicker clouds. Now, the cloud doesn't always act as extreme resistance and support. I have also seen it act as a magnet. The Kumo, for me, technically is a no trade zone. When everybody in the market was long right here, let me put this on full screen. Nope. When everybody was long on the market, when we broke into the Kumo here, a lot of Ichimoku traders viewed this as an edge-to-edge trade, when in reality, the Kumo can do two things. It can act as a magnet if there's huge liquidity voids from sudden drops that created that cloud in the first place. So for instance, this was actually a pretty natural drop right here. But let's say theoretically this had dropped down much faster, much steeper to about right here. Then it would create a really thick cloud to where, let's say it was a black swan event that did that in this case. There was no liquidity in there because there was no buyers because of the black swan event and the rapid decline. So I have seen price action enter into the Kumo before and then get sucked up right to the top of the Kumo or vice versa, because of the lack of liquidity that was there, the lack of price action due to something like a black swan event. So that's something to keep in mind when you are looking at the Kumo, is how black swan events or any other factors might affect it, and the fact that price action may have not occurred in a sudden and steep drop or rally, allowing the cloud to form properly. But again, back to this, everybody was long here viewing this as an edge-to-edge trade. In theory, people believe that once you enter into one edge of the Kumo, it's going to automatically go to the other edge. That might have been true at one point, but in these markets, that's not true. I couldn't have been more bearish when we had entered into this Kumo. Technically, this is a no trade zone for me. And the reason why I don't like to trade on high time frame Kumos when we're within it is because this is resistance for one. The edge-to-edge theory, the edge-to-edge trading just seems flawed to me when we're within a resistance zone. I'd like to see a break of it before, I can say we're out of the woods. There was a lot of prominent traders that got trapped in this Kumo that lost. I know one in particular that lost 4,000 Bitcoins by continuing to long throughout here and adding to their position on BitMEX, and they ended up getting liquidated. They're a very well-known trader, and they were on the top list on BitMEX traders, but they are no longer. I don't know if their reasoning was because we had entered into the Kumo. It's doubtful. That's a pretty stupid reason to base that big of a trade on. But be wary when entering into the Kumo. Every Ichimoku trader that's done a course and just about any professional trader that uses the Ichimoku would tell you, oh yeah, edge-to-edge trades are great. But in reality, I disagree, and I'm here to tell you that it can screw you more often than not. So use the Kumo as a no trade zone. I think I got into this, but let me cover it again, so that way I'm covering all the basics on this. I apologize if I'm skipping around, but generally markets are bullish when Senko span A is above Senko span B. Again, this is A, this is B, and they are bearish when they are flipped around, as can be seen here. Clearly, there is a trend going on. Now, if we go back to the bull market the last couple of years, we can see that we generally stayed above the Kumo the entire time, and the times that we did dip down into it, it also acted as support. Now we broke here just slightly below, but that can be considered an anomaly because the Kumo actually could have been much lower, and this again could have been affected by a black swan event or any number of factors such as a large trader or something like that. In addition to thickness, the strength of the cloud can also be ascertained by its angle, upwards for bullish and downwards for bearish. Pretty simple, right? Like I said, the Ichimoku is not all that complicated. I've had many traders say that it's such a complicated indicator and they don't use it. It's really not. Bullish, bearish, very simple, especially when it comes to the Kumo. Traders often look for Kumo twists in future clouds where Senko span A, and B exchange positions, a signal of a potential trend reversal. So let's find a trend reversal real fast. That's a bad example there. He's got one. No, that's actually lagging so far behind. Okay, so here's a Kumo twist. This isn't the best example because this would indicate that the market is going to drop further. I don't believe we have much of a drop in as far as further. To be honest, we're going to get into the weekly here in a little bit on, I think this number right here is the market's equilibrium at this point. That is our confirmation for the bull market. That big yellow line, which is the top of the Kumo, I think that's where we break somewhere along here. That's actually too far out. Somewhere along here, confirming our bull market, and from there, I believe all hell breaks loose up to about 20K, and we have a minor pullback, and then a ridiculous third leg. A third push up to around 32,000, but that's not something I'm going to get into today. But I am under the belief, based on the Ichimoku on the weekly, that this is actually the market's equilibrium currently, and anything below this is just noise and oversold conditions at this point. But we shall see. The next component I want to get into real quick. Let me check to see if I have any questions before I go into lagging span. Okay. Zach asked, is it a volume indicator and how does it relate to volume? It is actually not a volume indicator. It is based, if you go back to the beginning of this presentation, you can kind of understand that it is a moving average in a sense. It is the 50% point of price action. Each one of these components, I explained at the beginning, but it is based on, in a sense, I don't want to say moving averages, I keep do, but that's the best way to explain it. Moving averages. So it is lagging also. Double check chat. Can I repeat my setting? Yeah, it's 2061, 2030 as Josh put in there, Simmons. Again, all this, guys, will be available for review after the presentation is done. I'm going to leave this link up. Feel free to review it, take notes, whatever. I didn't do this in a PowerPoint presentation because, frankly, I'm sick of PowerPoint presentations. So I'd rather just talk and show you guys the chart. Plus, I do not do well when I'm reading. It's much better for me to just pull up a chart and talk about it. So I decided to do this just on the charts. But also, if you look up here at any time on the screen, in the top left-hand corner where this circle is pulsing, you can see 2061, 2030. Okay, so we are good on that. So the next component I want to talk about, which is not my favorite component, let's turn off the price so we can see this a little bit better, is the Chico stick span, I guess. Not really Chico stick, but the lagging span. It's basically today's closing price projected back 30 periods. So it's 26 on default settings. But if we take our little measurement tool here, oops, turn the price back on, and we go back 30 periods, you can see that 30 bars back is this line right here, which is the lagging span. We're going to turn off the baseline and that real fast, just so that we, oops, turned off the wrong ones. So that way you can see it. So yeah, it follows the price exactly, and it is basically a line setup like that. So if we were to displace this over, like so, with no displacement, it's on 1 because that's the bare minimum. You can see it matches up price perfectly if we put the price off of candles and onto line. See? I do not find this particularly useful. I'll explain why here in a second. Let me turn this back on. Displacement is back over. By the way, displacement settings affect your lagging span and also your Kumo when you adjust that. Keep that in mind. If we measure from here out, it is based 30 out, 26 on default settings. But generally, anytime the lagging span crosses up over a line, any line of the Ichimoku, also the price, this is interpreted as bullish. And anytime the lagging span crosses down under a line, this is interpreted as bearish. I generally find this useless. Some traders use this as a confirmation point for things. There is a few techniques that you can use with it, but I find all the data I need without having it on there. But I'll go through real quick the levels and strengths from signals in the Ichimoku and explain, why I guess the lagging span can be used as a confirmation of strength. So let's go down to something a little more volatile like the hourly. Anytime, so the ideal setup for a bullish configuration would be your slowest portions of the Ichimoku at the very bottom and your fastest moving components of the Ichimoku at the very top. So the ultimate bullish setup would be something like so, where you have the Senko span B at the very bottom, Senko span A. This isn't even a good example right here. We need a perfect example for this. Let's go back to the daily, and we'll go to when we were in a bull market, because I know we were prime then. So you have Senko span B at our very bottom, Senko span A, second to the bottom, and then we go, and then as we get higher, each component of the Ichimoku that moves faster should be at the top, with price action typically below that, because it is actually in real time displaced back 30. So you'd be seeing it somewhere over here. So let's replay a little bit, actually. Let's go back to right there. So in the heat of our bull market, when we were at 11,613, this is what it looked like. This was an ideal bullish setup. B there, A there, the baseline middle, conversion line above that, price above all that, and the lagging span trending upwards. Again, the lagging span is useless to me. At this point, it has already crossed over the conversion line and everything else. It really tells me nothing at this point until these lines begin to converge. Now, in a bear market, the most ideal bearish setup would look something like so. Let me find. Wow, we really haven't even hit a completely ideal setup. Yeah, we have right here. So back in March, this was about as bearish as it can possibly get. Right here, you have your, what am I missing here? Hold on a second. Most bearish configuration would be your Senko span B, as we can see here, your A, and then your baseline, as can be seen there, and then your conversion line. And then obviously this cannot cross below anything, so you could use this lagging span seen here in white as a confirmation that this is bearish. However, as it begins to cross back over, we did end up finding a bottom around here and rallying back up. And let's pause right there. The Ichimoku, just like with any indicator, has its flaws. We were looking pretty bearish right around here, and the Ichimoku would signal to continue to sell off as the baseline gets higher from the conversion line, and the conversion line continues to drop. So right around there, we were still looking, if we go back even further, pretty bearish as the conversion line gets further. And but as you can see, the price ended up popping up. So the Ichimoku does have, it is lagging, and it does have its false just like any other indicator, but it is an indicator to use with other indicators. So yeah, to recap, the most bullish configuration of the 5 components goes Senko span B, A, baseline, conversion line, and then your lagging span. Or if you want to go from top to bottom, it'd be reverse. And same with the bearish scenario. It's pretty simple. Your slowest moving components need to be at the bottom in a bull market or at the top in a bear market. Be careful on too strong of positions, though. Extreme conditions typically mean overbought and oversold, and this is nothing you will learn in any Ichimoku course. It's a lagging indicator, so keep in mind that when we get massive gaps like we saw here, that typically means that we are in oversold conditions. It is lagging, so when we start to see further and further and further away, at some point, what goes up must come down. So you see something like this, you don't necessarily want to go all in at 17,000 long, even though many traders did so, not based on the Ichimoku, just based on the rest of the world telling them to do so. So keep that in mind when you do see very large gaps in between there. Yeah, that can be viewed as extremely strong, but keep it in the back of your head that that is almost too strong. You want to see a nice, healthy gap such as there, and you also want to see some consolidation zones every once in a while instead of a just straight vertical. Okay, let's play forward. So analyzing the Kumo. It is important to remember that bullish signals are reinforced when prices are above the cloud, as we can see here, and the cloud is green. So in this scenario, this is a bullish setup. Again, this is a little bit overbought, but we already went over that. Bearish signals are reinforced when the prices are below the cloud and the Kumo is red. The Kumo is also the cloud, in case any of you guys missed this. Kumo, cloud, baseline, conversion line. We're going to turn this leading span off now at this point, because, or the lagging span. I keep calling it leading span. I mean lagging span. So a bearish cloud looks like so, if you didn't already know, and a bullish cloud looks like so. We had a nice little Kumo twist that was created from this drop right here. If we measure 30 periods back from there, right there is what caused the Kumo twist. If you didn't know it was a bear market at this point, I don't know what to tell you. The Ichimoku definitely shouldn't have told you that point. It should have been price action that told you. But for the sake of this presentation, that's what a cloud twist would look like, and that would definitely indicate to you when we are back there that, let's replay, that we are bearish. As can be seen there, it starts to plot, and it should have been very apparent at that point that correction was in when we had been green 4 years. We had some slight red there, but that was basically at the end of Impulse 2. And when we have a thick Kumo like this, yeah, it is correction time. There were still people that were doubting if we were in a correction at that point. There was also people saying that we were going to crash to zero and that tulip mania was over. So, yeah. Oh, you know what? I forgot to check questions on that last part. Let me check. Yes, Ripsauce will be available for review on this same link right here. Just come back to this link. Zach Dems asked, where can we find your educational playlist on volume and price action? The price action one is not quite public yet, but the volume ideas that I have done, the volume tutorials I have done can be seen here. If you go to my TradingView, tradingview.com/u/Nick_Core, or just go in up to the search bar, click people, and type in Nick Core or Nick_Core. Either one works. It'll bring in all of these. It does not have a way to filter through with educational pieces. I wish TradingView would fix that. They told me they were going to, but you have to scroll through and find the ones that say education. The GMMA is a moving average. That is not volume, but if you scroll way down, Here's head and shoulders ones. If you continue to scroll down, let's see, page 2. Here's one on the TD sequential, which reminds me, I keep meaning to publish volume 2 of that. Here is the one on the OBV plus CMF divergences, which actually, by the way, guys, was able to spot the top on Bitcoin. And I explain how in here. So I recommend you read it. Here's the one on the shock and money flow, but it was able to identify the CMF and the OBV on where our tops were. So I do recommend you read those. But yeah, that's where they are at. Oops. Back to this. That answer your question, Zach? I think so. Okay, awesome. Yep, you're just going to have to scroll through my trading view. There's no way to filter it between educational ideas and irrelevant trading ideas that are from the past. Trading view is really screwing up by not allowing people to do that. I don't get it, because you can do that when you are searching ideas, but you can't do that on a user. Okay, back to the Kumo. Like I said before, it is important to remember that bullish signals are reinforced when prices are above the cloud. And we'll get into each one of those signals here in a moment. In other words, bullish signals are preferred when the bigger trend is up, prices are above the green cloud, and bearish signals are preferred when the bigger trend is down, like our current market. Prices are below the red cloud. This is the essence of trading in the direction of the bigger trend. This is something very basic, but it definitely applies to Ichimoku. Signals that are counter to the existing trend are deemed weaker. Now, short-term bullish signals with a long-term downtrend and short-term bearish signals with a long-term uptrend are considered less robust. So there is one method that makes this simple on analyzing the strength of signals. You can take the most bullish configuration that I mentioned before of the 5 components, your lagging span at the top, conversion line, second from the top, baseline, third line, third from the top, leading span A, fourth, and leading span B from the very bottom. That would be your ultimate bullish configuration. Now, let's say you had a TK cross. Let's find a bullish TK cross. Right, so if we go back, clear back to October of 2017, which was actually not that long ago, we can see that we got a bullish TK cross. And what I mean by that is a Tenkan-san crossing, sorry, I got a text, the Kijun line, which is our baseline here in pink. Now, seeing as price action is above the cloud, above both the conversion line and the baseline, this is considered a very bullish signal. I am a big, huge, gigantic fan of TK crosses on the 4-hour. You can see we got a bearish TK cross here, but it was in response to this candle right here. If we play this forward, that's 10. Actually, so we're even going further back. That is in response to there. I am wrong again. What is this in response to? You need to quit eyeballing candles and just measure. Okay, so that drop right around here. The 4-hour, for some reason on Bitcoin, has been really good on TK crosses. You can see here, if we replay this, what a beautiful cross. I feel like Tone Bays with his 9s right here. Pause. So this is an interesting scenario on the 4-hour. We had the TK cross as the price enters into the Kumo. That's a no trade zone for me, but it also can be considered bullish. What I don't like is that the price action is going right back and forth between the conversion line. For a more bullish scenario, as we can see it spiked up, I'd like to see it break above the conversion line. So once that candle closed, considering this is a no trade zone, I probably wouldn't have entered in based on the Ichimoku alone. I would have had to look at other factors such as volume and oscillators, also strength indicators, and seen if I really wanted to override my rules of a no trade zone within the Kumo. But as that crossed there, this would have been a perfect position. Let's say the Kumo was not here to enter into a long based on that TK cross. And as you can see, we ended up skyrocketing. And the same goes for bearish signals. Let's see if we can find a nice bearish TK cross here. It's a fairly bearish scenario. Let me get back on track. So you can use a number system, assign 1 point for every bullish or bearish scenario depending on the direction of the trade. So for instance, if you were looking to go short here, you would assign a -1 to the fact that it is in a bullish green trend right here with Senko span A at the top. This is not typically a bearish indicator right here. So you'd assign a -1 there. You'd also assign a -1 for the price being in the Kumo, but you would assign a +1 for the bearish position, considering price action is below both of those. And you can do a system like that or create your own to assign the strength of the position based on the Ichimoku. Now, again, do not use the Ichimoku as your sole indicator. Use it with other indicators as a reinforcement and also use it for your support and resistance. But it is good at trend identification and trend strength. I'll leave it up to you to decide how to factor in each one of those bullish or bearish signals for your own system. But again, for a bullish configuration, you would want the slowest components at the bottom of the chart with the price above all of it, and bearish vice versa. And you can assign a point system to that. Let me make sure I've covered everything I wanted to cover on that. Again, signals that are counter to the existing trend are deemed weaker. So you want to always take a look at the trend. Let's take a look at the chat. Josh says, looking forward to the live CMF OBV lesson. Just go read it. I'm not doing it live. Simon says, I feel like Ton Vase with his nines. Yeah, I know, right? Okay, so let's go to conversion and baseline signals. The list of signals and strategies from the Ichimoku is long and never-ending. There is a never-ending list of strategies that you can do with the Ichimoku. Some of the most common ones, though, I'll go over. And keep in mind, any signal from the Ichi lends more credibility if it's with the overall trend of the Kumo. So keep that in mind, and don't always rely on a TK cross or an edge-to-edge trade or a baseline touch, anything like that, without taking a look at the overall trend. We went over what a TK cross is. So a bearish scenario would be, let's remove this price. A bearish TK cross would look like so, with the slower moving baseline, also known as the Kijin, crossing the Tenkan-san, which is also known as the conversion line. That would be considered a bearish price signal. But one second, I need to turn off my text. I'm getting way too many texts and it's distracting. The higher time frame signals that occur are typically the strongest, but they also take the longest to transpire. So when you're looking at some of these signals, let's turn on price and see if we get lucky on my example. This one actually occurred pretty quick. That TK cross there happened, and we ended up dropping very fast. Same with the bullish scenario. Keep in mind on larger time frames, as I've repeated many times, they take longer to repeat. But there's also less noise. On your lower time frames, when you get some of these TK crosses or Kijin touches or anything like that, you're going to have a lot of unfiltered noise because of the amount of volatility we get with Bitcoin or crypto in general. The lower the time frame, the more noise you'll get and more false signals. Just like with any indicator, it applies. Let's move over to, again, I don't think I covered this, but the baseline can also act as a support. It is your major support or your major resistance. You can see here we generally followed this entire conversion line as resistance. Had it break through and close above this, then we would be looking for a close above the baseline in pink there, but it never does. Every time we have broken above the 3-day conversion line, which is in the most ultimate bearish position right now, other than the decline of the baseline there, which can potentially cause a bullish TK cross. Let me explain this real quick. So this is converging right now on the conversion line, not because the price is dropping. It's converging because we're getting chop action that has no direction right now. So as this baseline catches up to price, and as time goes on, it'll get closer and closer to price. So let's say this price goes completely sideways, clear over here. Eventually, this baseline will come down and have an equilibrium with the price and the conversion line, which more tracks the actual price a little bit closer. Now, again, Senko span B is the average of these two, the midpoint. So at some point, this would begin to come down also. But the reason for this dropping, which can create a bullish scenario of the conversion line crossing the baseline, is because of the chop action. Now, if we cross over here to the weekly, let's see what's happening there. We are actually getting further and further away there on the baseline and conversion line. That might need some studying to do. I'd like to look at that actually. But as you can see here on the daily, not the 3-day, we found a little bit of equilibrium there. Okay, price relation to the Kumo. Let's go down to something more volatile time frame. So back here, we had a bearish scenario with the Kumo. We broke into the Kumo and ended up rejecting at the top of it, closing, coming back down, tried at it again, and we had what's called a Kumo breakout. Now, again, I am not a fan of creating trades in here for this very reason. Yes, you could have done an edge-to-edge trade there, but you could have done a lot of things. You could have also long down here. There's a number of ways you could have traded this candle right here. The Ichimoku was not one of them to trade this candle. The rejection there, though, probably would have been a pretty good signal that if you were an edge-to-edge trader, you could open up a short and trade it down here, close it there, and then open up a long. However, I think most traders would have been scared out of their position at this midway point and not traded it. But if you're like me, you wanted to trade the Kumo breakout, you would have waited for a close above the Kumo and bought there, considering the conversion lines above the baseline. The overall trend is not bullish, but it is bearish. We would have taken a point away there on the strength scale of the position. But you could have traded that breakout right there, come down. As you can see, price pretty much found its equilibrium on the conversion line, ended up breaking down through that because we tested it again. I'm under the belief that if you keep testing support, you will break support. Came down, we broke support. We went down to our secondary support, which is at the baseline. Now, there's a number of ways to find support, guys. You can use the VPVR, which I've done a tutorial on, which is the volume profile on the right, those colorful bars, which is price level volume analysis, not so much time volume analysis like you see down here on the indicator that everybody has on their chart. There's a number of ways you can find it, but the Ichimoku allows you to find support and resistance levels also. So we had broken through support 1, come down to support 2, held, we ended up closing above it, but then we wanted to test it again, we closed it and broke below it, creating another bullish or bearish scenario. As we chopped through this ridiculous price action going through, the moment this broke here, broke the Kumo, that would have been a pretty damn good signal to go long there, and that you could almost predict that the TK cross was going to happen in the bearish fashion. Now, here we're in a bearish scenario. We're above the conversion line, the baseline, Senko span A, Senko span B, and price was continuing to test that support. And of course, we are in a bear market overall. So what happens when we're in a bear market? The trend is downward, right? And we end up breaking support as we keep continually testing it. Now, the hour is not a good example of our overall bear market, but that's just for the sake of this conversation. Let's fast forward. Take a look where we're at on the hourly. So again, big bearish Kumo, price actions below it, conversion line, which is the slower moving of, or I'm sorry, the baseline, which is slower moving of the conversion and baseline, is way up here, price is way down low, and we keep testing this conversion line right here. I don't want to see us keep testing this conversion line. That's not a good thing, guys, especially in this scenario right here. We better see some serious volume. I don't have any volume indicators showing, but we better see some volume, serious volume come in. Otherwise, this is going to break back down. Again, this is purely based off the Ichimoku, not the other indicators. So keep that in mind on everything I just said. I got into edge trading already. I jumped ahead on that. I was going to cover that now, but again, I'm not a fan of that. Let's check questions here in a second. I did cover that a flat Kumo can act as a magnet at the beginning of this, but I will cover that again real fast. The reason why it can act as a magnet is because the price maintained such a flat price level for so long, which can be considered a consolidation and a gathering before a bullish breakout. So when you do, every once in a while, when you do cross into these Kumos with this flat Kumo top, it can act as a magnet because so much consolidation has happened that sellers are worn out. Buyers were able to maintain this level, and we're able to break upwards. Sellers ran out, and then we find another support level, break that, and create new support levels slightly higher. That would be an ideal scenario right now, seeing as I'd like to see a stronger Bitcoin bottom, but that's not what the Ichimoku is telling us right now. But theory is once inside the cloud, it'll at least touch side to side. I am not under that theory or that belief. I'm against that theory as the Kumo is viewed as resistance and support, and it's simply waiting to break when it is inside the Kumo. That's one example on, back to this little scenario that we had back then when the entire market was bullish. I was not. This is so thick because we are waiting for the market to break, or because of the such large drop as we get in here. We're waiting for the market to break. That's what I'm looking at these support and resistance levels as. We're waiting for the market to break, and it's not a breakout. So that's why I typically do not trade within the Kumo or do edge-to-edge trades. Let's check these questions. Zach, do you use X time frame versus X time frame as a confirmation to put on any given trade? I'm not sure what you mean on there. If you want to clarify in chat real quick, I'll answer that. Simon says, do you like to use multiple time frames to look for multiple reasons for signals? 1, 3 hour, 6 hour. Yes, I do. If you've watched any of my trading in the past, or any of you guys that know me in the past, you do know that I am big on multiple time frame trading. I like to confirm things across multiple time frames. When I do my full analysis on the markets, I like to start way up on like the weekly or now the monthly, now that we have enough data points to look at the monthly. And I like to work my way down to smaller time frames. The same applies to the Ichimoku. I'll give Zach a moment to, you know what, guys, we have flown through this pretty fast. So if you guys have questions, go ahead and fill up the chat real quick, and I'll wrap up with a few things. But yeah, I feel like I've missed something, but going through all my notes, I think I've covered everything I wanted to cover. It just moved a lot faster than I thought. But a couple tips while you guys write your questions in. Follow the market. Don't trade to lead it. The Ichi is a trending indicator, so you must learn to follow it. Again, another reason why I am against the edge-to-edge trades of the Kumo. I feel like you are leading the market at that point because you are under the assumption that it is going to happen instead of following the Ichimoku. If the Kijun is flat, then look for the Kumo for guidance. So one thing I guess I forgot to entirely cover is the Kijun. I did mention it at the beginning, will act as a trending versus a chop indicator. So when it is flat, we can say that we are just in some chop, and this is not a trending market, typically not a tradable market. This is not a market you want to trade unless you're very skilled and can trade from one end of the channel to the other. I am a channel trader, guys. I love to create little channels, very low time frame channels, and trade those back and forth through leverage. I'll find a support and a resistance level, and I'll trade them. But when it comes to the Kumo edge-to-edge trading, I do not do that because, again, I'm waiting for the market to break. So I do love channel trading, but the conversion line, again, will act as a trending or a chop action indicator also. When I say chop, I mean ranging also, for the guy that just sent me a text message on my phone. Okay, we'll get into questions real quick. A couple more pointers. The Kijun's trend is very helpful for those that are not familiar with the directional trading, the conversion line there in orange. It's important to use other indicators and not rely solely on the Ichi. It has limitations, just like any other indicator. Let's get into these questions. Eugene asks, when the TK cross is not clear, when two lines converge and stay together as one line and then break. Is that a question, Eugene? Example, BTC, BCH, 12 hours, Bitfinex now. All right, let's pull that chart up. Nope, that's the dollar. I don't know why I can't see the BTC pair for Bitfinex on this. There it is. And what was the time frame you had said? 12 hours. Yeah, so that's typically a ranging indicator right there. Yes, it is broken bullish, so you consider that a bullish trend, but again, it's in response to that rapid movement upwards right there. In this case, with Bitcoin Cash, knowing that it's going through a fork, if you're just looking at a naked chart with no idea about the news, you'd be like, okay, yes, that's bullish, but at this point, I would not be using the Ichimoku as a trend identification for Bitcoin Cash. It is fork FOMO causing this, not natural supply and demand. If this was natural supply and demand, it would not be doing this. Okay, Josh McGruff. I hear folks talk about C clamps being used as an indicator on the Ichi. Can you talk about C clamps? Here in 1 second, actually, yeah. Yes, I believe it was answered. Although for the cloud indicator, would you look for a twist on the 1 hour and then look at the 4 hour for a potential twist? Okay, so this was your second part of your question, Zach. I didn't mean to skip over your question, Josh. I'm just trying to figure out what Zach was talking about. Do you use X time frame versus X time frame as a confirmation to put in any given trade? Okay, I believe I answered it. Okay, yeah. So yeah, if I see a cloud twist in the 4 hour, I might drop down to the 1 hour and see if it is, in a bull trend also. Yes, Zach, it is a lagging indicator and you do lose a lot of potential gains. But you know what you don't lose is the trades that you tried to predict that you are wrong on. You will predict more wrong trades than you will predict right trades by trying to predict a lagging indicator. It cannot be done. Take it from me. I've been trading since 2004, using the Ichimoku for quite a while, probably close to that whole time. But in general, traders that have longevity trade on confirmation. Yes, all TA is predicting the market, right? But there needs to be a balance or an equilibrium, pun intended, in that. And confirmation will save your butt more often than not, and it is worth missing out the potential profit that you'll lose to have a confirmed setup. You may not listen to me and you may learn the hard way, but take it from me, confirmed setups are much better to miss out on potential missed profit. Promise you that. You will have much longer longevity that way. Any advice for using the cloud on less liquid markets? Don't use. It depends. So you could still use it on less liquid markets. There's a difference between liquidity and volume, or volatility. So if it's a less liquid market that's not very volatile, then perhaps turn your settings way down. If it's something with not a lot of, okay, there's new listings all the time on markets, right? Let's say you wanted to use the Ichimoku on a new listing where there's not a lot of price history, like on the daily, let's say. If you go to Binance right now, there's a number of coins that don't have really any Ichimoku data on there. So you drop down to a smaller time frame, something like 15-minute or so, and then you can get some data points there. But as far as liquidity goes, not so much. It's just going to be flat depending on the volatility. So the Ichimoku moves and signals based on volatility, not so much liquidity. Zach and might be able to get in if you looked at smaller time frames. Yeah. Niels, I just came in here real quick to say I love you, brother. Good night. Love you too, brother. Much love. Much love to everybody at Ivory Mountain. or I'm sorry, Bitcoin Masons, not Ivory Mountain, Bitcoin Masons. Do you believe in binary options? Have you ever traded them? That's a whole other conversation, man. This is the Ichimoku course. No, I did not say. Simmons asked, did you say the baseline act as a magnet? I did not say that. No, if I did, that was a mistake. I was saying that the top of the Kumo or the bottom of the Kumo will act as a magnet. The baseline typically acts as a support or resistance level, a secondary support or resistance level. Alrighty, guys, I think we will wrap this up. I thank you for it. If you guys have questions, you guys know where to reach me. Feel free to DM me. Everybody in this chat, let's go over. Oops, here we are. Everybody in this chat that's seen this, I will try my best to answer your questions. Please clarify them the best you can, though. Keep them short, sweet, and concise. And that's how you get an answer from me. When I get really long questions that require a lot of reading and a lot of time or multiple explanations or a debate, such as something with binary options, I typically can't get to them. I don't mean to be rude when I am I don't mean to be rude when I am doing that, but it's just the reality. Like, I get so many DMs a day. You guys have no idea, between Twitter, Discord, Telegram, all of it. But generally, I try to answer questions, especially if they're educational and not win targets. So if you have questions and you're viewing this, if you have questions about the Ichimoku, feel free to send them to me. And if they're short, sweet, and concise, I will answer them short, sweet, and concise back. Thanks, guys.